Hedge funds. We've got the long and short on investing in these controversial funds. And coming up after the break, hedging your bets inside an investment once reserved for the super rich, the hedge fund, and what it means to the average investor. Next on Business Unusual. Stay with us. Hedge funds, known as the high-flying investment for the super rich. Even if you never can get in on one of these funds, it doesn't mean your portfolio won't be affected by this type of high-risk investment. Joining me now with details from Raleigh, North Carolina, Charles Gradante, President and CEO of the Hennessee Group, a hedge fund investment consulting firm. Charles, thank you for being here.
Hi, Allie. How are you?
Good. Listen, we have heard, I do a show during the market day, and all we talk about is how the hedge funds have really come to dominate trading at the New York Stock Exchange and on the NASDAQ in the last several months. What does that really mean to the average investor?
Hedge funds are not the bad boys of this bear market. In fact, hedge funds are only about 6 to 10% of the average daily trading volume. Most of the volatility and the volume created in this market is not by hedge funds, although hedge funds can impact the market on the fringe. Your program trading is 38% of the volume in the market, and financial futures managers, also called CTAs, regulated by the CFTC, have been trending this market down. The futures market is the tail wagging the dog.
What role do hedge funds play? Because we do know that there's a lot of money that is affecting the volatility.
There's $563 billion in hedge funds. We have a $7 trillion stock market, so they're really a small component. And as I said, on the fringe, they can move the market at a point in time, but the biggest moves in the market are your sell programs and your buy programs executed by investment banks for their own proprietary account or for the account of their clients. Institutions like pension plans need to rebalance between equity and bond allocations, and that rebalancing causes a lot of volatility intraday. And then you have financial futures managers who have been shorting S&P 500 futures for the last 2 years, and CTAs are up 18% in the last year,
all right,
while hedge funds are flat.
Let's try and make sense of what we mean then when we talk about hedge funds. What are the characteristics of hedge funds? Largely, they're unregulated, they're not accessible to retail investors generally?
Well, yes. Hedge funds are unregulated. These are money managers that can go long and short securities, they typically are available to high net worth individuals or institutions. They have yet been afforded to the mainstream market, although institutions like Charles Schwab, Merrill Lynch are starting to offer hedge funds in a mutual fund format.
To retail investors?
To retail investors, that's correct.
What's the main benefit of a hedge fund? If a retail investor were to go to a Charles Schwab and want to get involved in hedge funds, why would they?
The main benefit is the downside risk management. That's the mantra of hedge fund managers. By being able to short the stock market and perhaps even make money on shorting stocks, as well as being long stocks or buying stocks, they can reduce volatility and compound better returns in the long run. And
in fact, there are hedge funds, for instance, which make money. They're called market neutral hedge funds. They make money whichever way the market's going because they play different things.
Well, that's what they try to do, but market neutral managers can have problems from time to time, but you're right.
Let's talk about regulation. With all of the eyes on regulation, do you think the SEC is interested in trimming down the number of hedge funds that are out there and perhaps regulating them more? In fact, you can call yourself a hedge fund for a lot of reasons that may not accurately reflect what the fund does.
I think the SEC's current investigation of hedge funds is appropriate. I don't think their objective is necessarily to trim them down. I think they're looking at disclosures. Hedge funds are known not to disclose very much. However, hedge funds do report their positions to the SEC if they manage over $100 million. I don't think the SEC is on a witch hunt.
Yeah.
I just think they want to get to know this asset class since it's becoming a very popular.
Yeah. Your advice to the average investor about hedge funds and how to deal with them?
I think the average investor should look at what the institutions are making available to the marketplace in the way of hedge funds, and seek advice and do good fundamental analysis. But I do think it is the preferred way of managing money. Bear in mind that investment banks, when they were partnerships before they went public, managed their own proprietary capital as a hedge fund. In fact, your largest hedge funds are places like Goldman Sachs, Merrill Lynch, and Morgan Stanley.
Charles, good to talk to you. Thank you for being here.
Thank you, Ali.
Charles Gradante is the president and CEO of the Hennessee Group.